and welcome to our July investment market update. Today, I'm joined by Janet Mui, who is actually becoming one of our regulars. She's done three presentations, or this will be her third presentation with us in the last sort of 12 months. Janet is Head of Market Analysis at RBC Brewin Dolphin. Janet, thanks ever so much for coming on again today.
Thank you for having me, Mike. Really a pleasure.
Great, thanks for coming on. Right, so as with all these things, what we tend to do is bring up some slides. I think you've got some prepared for us already.
Yes, I do.
Like
Let me share it, yes. I hope you can see it.
Just come up now, so that's perfect. So title is the market outlook for the second half of this year. So just to contextualize it, the last investment update, we talked about when are things going to get better. So hopefully there's a bit of progress on that theme. But Janet's kindly pulled together some slides for us, some really interesting macro information you've got here, some thoughts on where interest rates are going. So I'll hand it over to you, and as ever, I'll jump in on occasions if that's all right.
Yeah, sure. Please jump in. Thanks, Mike, for the introduction. And yeah, let's kickstart. So my webinar would be talking about the market outlook. As Mike mentioned, I think indeed there has been some good news. I mean, we saw the market actually doing pretty well in the first half of the year. So I'm going to go through all those good news, but also highlight some of the potential headwinds going forward. So first of all, we have to understand actually we are in a very unusually high macro uncertainty environment at the moment, right? So we have seen, of course, a very high inflation over the course of the past 18 months. And as a result, interest rates have been hiked very aggressively. So this is, we are not really accustomed to that for the past 10 years or so, right? Interest rates were stuck at zero, inflation were very, very in line with target. Or, if you remember, people were actually worried about deflation. There was not much inflation, but now there is so much. So we are in a very elevated macro uncertainty, high volatility environment. And of course, that impacts the economic environment. People are worried about a recession. And at the same time, of course, we have got the geopolitics at the background, which we have the war in Ukraine is still ongoing. And then there's also tension between the US and China, which is ongoing in the background. And occasionally there is some escalation in terms of trade. So technology also, there's some good progress on artificial intelligence, etc. So lots of things actually happening at the moment. So it's actually a very difficult time to actually dissect where the economy is and how markets are going to do. But we try our best. And so far, actually, there has been some good news. And primarily it's from the US economy, because we actually saw very meaningful slowdown in headline and core inflation. So that's great news because US economy is #1 economy and the markets absolutely care about it. So inflation coming down is very significant because it means that the Federal Reserve can finally maybe see the peak of the interest rate hiking cycle. And a lot of analysts were actually expecting that this month we're going to get another hike and that's it. So this is a very, very positive and significant development. And we'll talk more about inflation later, and of course, comparing that to what happens in the UK. So another very positive development is we have seen some of the stress in the US regional banking sector earlier in the year, but that has mostly stabilized. You can see that from the data, from the bank deposits and the credit data. So they're all fine, stabilized a lot after a period of volatility, thanks to the swift action from the officials. And there's also resilience in the job market, generally in the US and also in the UK. In the US, the job creation continue to be very strong. Unemployment rate continue to hover at around record low levels. So yeah, it is very hard to see a recession in this kind of strong job growth environment. So we're having a pretty good scenario at the moment, actually, where inflation slowing down nicely and the job market staying good. So that's really the soft landing scenario a lot of people were hoping for. So that is still a possibility, not ruling that out. So inflation, as you can see from this chart, is a good development. So we understand the UK is currently still facing 8.7% inflation, which is not great. But the US market is what really the global market focus on, to be fair. And it has slowed down from, 9-ish to 4. It is pretty significant. To 3, actually, to 3%. So that is very significant because we're almost back to that 2% target. And we saw that Euro area as well, it is slowing down 5.5% at the moment, and all the way from 10. Very good development. So I think the read across to the UK is, I think we'll eventually also see that slowdown in inflation. It's just that we have this energy price cap mechanism, which creates a lag between the transmission mechanism of lower wholesale gas prices. And of course, there are some idiosyncratic factors within the UK economy. But if you read across, there's no reason to expect why the UK inflation wouldn't slow down as well. In fact, if you look at the economist forecast from consensus, right? So I took this from Bloomberg Economics. The dotted line shows the expectation of where inflation is heading. I think the consensus is still expecting a slowdown in headline inflation for the UK. And in fact, if you look further into the future, say later part of 2024, actually UK and US inflation are very likely to be, in sync at just above 2%.
So Janet, on this,
yeah.
on the sort of the inflation, if you look there, obviously the US inflation went up before UK inflation.
Yes.
There is a lag, obviously, in the UK inflation coming back down, but they are following a similar trajectory.
Yeah.
Just there's a bit of a delay in the UK, and as you said, if some of that is linked to the fact that the price caps and the mechanism is a bit slower, but is there also reasons around the sort of the impact of interest rates in the US being quicker to hit? Say, for example, borrowers and mortgage holders in the US, do they have a slightly different market to us in the UK where we're predominantly fixed rates, or is that not the case?
Yeah, there's a huge difference between the US housing market and the UK housing market. Actually, the US mortgage market has a very long maturity and duration. Is mostly they fix for the duration of their entire mortgage term. So 30-year is very prevalent. So huge difference from the UK where they fix 2 and 5 years. So I think interest rates are hiked faster in the US. They had quite a couple of 75 basis point rate increase. So you can argue that actually the US has been hiking much more aggressively than the UK. And that's why the Bank of England is actually trying to catch up. But I think one of the more important reasons for US inflation coming down is, don't forget, they have a very strong US dollar last year. And that really helped with pushing down the imported goods prices. And of course, they're actually energy self-sufficient. Their gas prices is actually way cheaper than what we're paying. And they reflect it pretty quickly in their headline inflation data as well. Because
they're obviously a net exporter, really, aren't they?
Yeah, they actually
their energy rather than importing like we are. And obviously also because the dollar was strong, a lot of our inflation has been built through energy because of oil and gas being mainly traded in dollars. So it's no wonder that we've obviously had a bit of a longer tick on inflation, as well as those other things you mentioned. So that's really interesting. Thank you.
Yes, and I think the read across is, we will eventually see the same dynamics playing out, because one of the key observations that we have seen is that producer prices is falling across the board. So China, people are actually talking about deflation, and China is a huge exporter of goods that the Western economies consume. So we are going to see that actually eventually. So goods disinflation is going to be important. So the really crucial thing is the labor market, right? The wage growth that affects the services sector inflation. So that is still elevated. But we think with a slowing economy going forward, that should also sort itself out. So I think it is always hard to predict where inflation is going, but it is reasonable to think that the UK will follow the US slowdown in inflation eventually. So
there's also been a lot of talk in the press about, for example, Tesco's and companies like that profiteering through not, and banks as well, actually, in terms of savings rates and things like that, by profiteering by not passing on those reductions that they're seeing coming through. Do you think that's a fair point about what they're doing? Do you think they are profiteering, or is it just that's a natural market cycle? And
to be honest, I think prices are really set by market forces, supply and demand. That's really what economics is. So when you have inflation, don't forget these retailers, they also saw their cost rising very significantly. It's the cost of production, it's the raw materials, is the exchange rate that wasn't very favorable last year. Remember, pound was very, very weak. And of course, they have to pay high wages. So in the initial stage, it's fair to understand why they put prices up, because they want to protect at least their profitability. But I think when the economy slows, when people have to shop around, that's when the changes happen. That's when they realize they can't keep pushing these price increases. And similarly for the banks, right? At the beginning, they may not want to pass so much higher interest rate to the savers, but eventually people will know it's supply demand. They will shop around and look, where is the best rate? And when you see customers leaving, they are gonna have to force to.
So it's a matter of time, really, isn't it? Is that there may be a lag, but eventually market forces will take over and the competitiveness will come back again. But naturally, businesses, if they've been hurt a little bit earlier in this cycle, may be trying to recoup some of those losses. It's a classic, isn't it? They want to possibly delay passing on those cost increases to try and be competitive, but then when they do pass them on, then there's the pressure to come back down immediately again. And so maybe they got to get squeezed a little bit in the middle. I just thought it'd be interesting to understand from your perspective, because there's obviously a lot of rhetoric out there about, not passing on the cost drops to everyone, and therefore inflation's not coming down as it otherwise should do. But thank you very much for that. I appreciate the overview of that.
Oh, you're welcome. And I think that it has a very important implication on interest rate outlook. So this slide basically summarizes where we were, where we are, and where we're going in the next 6 months or so for the rest of the year. Basically, well, you can see we came from basically zero interest rate, well, in the euro area, negative interest rate, right? And currently, bank rate is 5, US 5.25, and euro area 3.5. But so the highlighted line is basically where market is pricing in for the future rate level. So for the UK, you can see we are going to see the highest interest rate out of the 3 big economies, 6.1% being expected. And I have to say, it has come down recently. It was as high as 6.5%. But after the US inflation data slowed to 3%, market think, there is likelihood UK inflation will slow. So let's revise down that interest rate expectation. So 6 is still pretty high, but not as high as 6.5 previously expected. So that is primarily because we still have high inflation. So remember, these expectations can change. If we do start to see inflation slowing down more rapidly, then markets will also adjust these expectations. But I think for the US, it's pretty much set and done, because inflation at 3, there's nothing to argue against that. Basically, it is a very good number. So markets expect potentially maybe another rate hike, and that's it. The Fed will be done. All right. So that is good news for markets. And that's why we have seen the US equity market, particularly the tech stocks, have been rallying. So we agree with that. We think that the Fed is pretty much done. They really have got inflation under good control. So for the euro area,
Europe doesn't seem that much far behind either, does it really?
No, it's not. Markets are pricing in another maybe 0.5 percentage point of increase from here. The problem is the area actually see very different inflation rates amongst their economies. You have, say, Spain, which is actually has below 2% inflation, where some of the Eastern European countries, they're all closer to 10. So you have range of inflation in your area, which is a bit tricky. So I think the Eurozone, they have to raise interest rates a bit more, but they couldn't do it too much. That will affect the other countries, which are actually seeing pretty low inflation already. So for the UK, right, I think we can talk about the mortgage rates. So mortgage rate is a function of market interest rates, actually. So what you see when you fix your mortgage, they actually reflect what the market already priced in the interest rate. It doesn't reflect the current level of interest rate. So you can see basically right now, the UK swap rates, which is the market reference for mortgage rates, you can see that both 2-year and 5-year has already risen, right? Well above what the current level of bank rate is. So the mortgage rates that you see is usually this swap rate plus a spread, plus the profitability that the banks have to add on it, right? So to be fair, I think if the market expects already interest rates going to 6, I think we are probably going to see the peak of that fixed mortgage rates. But of course, it's very hard to say. If market decided that, well, the Bank of England has to go further, has to go to 6.5 or even 7, then of course these swap rates have to go up more. But what we think is that probably these market interest rates have already reached a peak level.
And interestingly, on that, when we saw sort of a few months ago that interest rates, or the Bank of England rate was, say, at 4%, we were actually seeing that the mortgage rates were coming in cheaper than that. So the swap rates were obviously different to what was going on with the Bank of England base rate at that time. Obviously, what we've seen in the last couple of weeks is that it's gone a bit crazy, because obviously all the mortgage lenders, all of their rates that they'd been offering, they've now got to pull out and reassess. Now, obviously, that gets negative press because they're saying everyone's pulling mortgage deals. Well, they are, because they've just got to reassess the values and what they can offer to clients over that period of time. That has actually calmed down for us. So we had 2 weeks of craziness, and now actually it's again calmed down a little bit. I think probably as these numbers come out as well around inflation in the US and so on, that maybe that does calm the rates down. I mean, at the moment, obviously swap rates look like they're still pretty high, but fingers crossed, as you mentioned, that might be they're now peaking on the basis that they're pricing in already the increase in interest rates within the UK.
Yeah, I hope so. I think the pain threshold is widely expected to be 5 to 6% from the Bank of England's assessment. So, I mean, they already know that there's going to be more pain for the UK household. It's just not being felt yet because of the structure of the UK mortgage market, which is fixed, and then people have to refinance at a later date. So we'll see more pain in it. So I doubt they need to actually hike interest rates much more to slow down inflation. But I think they're pressured. They're pressured to actually be hawkish, I think. So what about the longer term outlook for interest rates? So again, I have to stress that market expectation actually changes all the time. If you have good data, it can really make a big change. So for example, the US CPI number came out this week. There was huge change in market expectation, for example. So I think just to let you know, if you read this, bear in mind that it can change in the future. But just to give you an idea of the market expectation. So this chart, it shows the longer term market pricing of the interest rate all the way you see go into 50-year. Of course, 50-year is just way too long. So let's focus on the near term. So you can see that the blue line is the UK, the pricing of the interest rate, and the green line is the US. So you can see what we have already told you, which is UK interest rates going to be higher than the US one. And you can see that the peak is expected to be about 6, right? If you go longer term, so 3 to 5 years, you can see that generally interest rates are expected to come down, right? That is what the market is expecting, which is fair, because what you tend to get is that high interest rates eventually trigger an economic slowdown or recession. Then inflation slows and central banks have to cut interest rates. That's how a cycle works. So you can see further down the road, interest rates are expected to be lower from here, right? But equally, you can also see that we're not going back to 0. So that is what the market is pricing and telling you that.
They're going to be staying probably a bit higher than what was anticipated they would settle in. I mean, I think this time last year, people were saying, well, once they peak out, they'll settle around 3 to 4%. Yeah. Actually, this is suggesting that even in sort of 3 or 4 years' time, we're still going to be up in the 4s and 5s.
Could be.
Bit of a shock, actually. That sort
Yes.
of means that these times are here to stay, and interest rates are going to be higher, and mortgage rates are going to be higher as well for a lot of people. So
Yes, but I have to stress that these lines really do move a lot. It really just takes some numbers and then they can shift. They shift up and down. So because nobody has a crystal ball where interest rates are going to be, where inflation is going to be 3 to 5 years ahead.
Exactly. It's making such a large number of assumptions here, because if the UK economy, for example, isn't really doing anything, then they're going to try to stimulate it by reducing interest rates faster and quicker. So this is all based on what ifs, buts and maybes, I think, rather than there being a necessary. I think really what this is highlighting, where they think it will peak. And then it's anyone's guess how quickly they may or may not fall. Is that fair?
Yeah,
comment?
yeah. So I think we need to revisit that from time to time. I mean, that's why I'm saying we're in a very high macro uncertainty at the moment, because in the previous 10 years, can you believe it? These lines are very flat and very low. Doesn't really move much, but now it's just very volatile. But I think it is factual. So it gives us some reference point. Nobody knows what will happen, but at least it gives us some reference point and factual stuff from the markets. So I think, so now talking about the markets, I think an interesting development is that, of course, as we see interest rate rises, as we see bond yields rising, yield is back. So yield is actually getting attractive. So you can see FTSE All Share dividend yield is now 4.2%. You get higher yield from a 2-year UK gilt yield. It's completely safe. So it is attractive. I have to say, our clients actually really warming to it because there are also tax advantages with holding UK gilts directly. The UK gilts is offering you the highest yield basically across G7 economy. So US 2-year is only offering 4.7%. And I have to say, these yields are really up for grab, because I was updating these slides, right? So previously at the start of the week, the UK 2-year gilt yields were 5.4 and the US one was 4.9. So a matter of days, it is lower already because of the US CPI data.
Is that likely to mean we're going to see inflows of foreign money coming into the country to sort of be buying these gilt yields?
I think it is definitely attractive. And that's why we're seeing a strengthening in sterling these days.
Right.
Because the yields are really the highest amongst developed economies. And unless you really think the UK government is going bust, you're going to get your money back. So I think this is really getting attractive.
And so if sterling's is stronger, then that equally helps in terms of reducing the cost of, energy and oil and imports, which equally has a deflationary impact as well. So I think what it shows to me is that there are so many moving parts that have interaction with each other. Sometimes it's really difficult to determine what the outcome might be, hence why they can't determine where interest rates are going to go. But one negative can promote a positive on the other hand. And I guess that's another reason for the mechanism of interest rate rises, is not just to sort of reduce people's spending capability, but also in this example, make the UK more attractive place to place money and obviously increase sterling's value at the same time.
Yes. So this time around is very different from the mini budget situation because people do make comparison. They say, well, the 2-year yield is higher than where it was during the mini budget, but the big difference is sterling is not tanking, it's actually higher. So that actually helps inflation. So that's a big difference there.
So that's a big positive then, isn't it? So it's not a true comparison. Yes, headline wise, they're the same level, but actually underlying economy and underlying strength of sterling is very, very different, which gives you a different feel as to what's going to happen.
Yeah, don't forget sterling is a barometer of investors' confidence on the UK. So the rise in the yield is more reflecting the inflation situation rather than the confidence, but the Liz Truss mini budget is more the deterioration in confidence, which is bad. But this is this is different. This is sterling. Sterling is actually strengthening, right? We're 130 to the dollar. So it's a big difference versus we're talking about parity.
Yeah, parity. Absolutely crazy, wouldn't it?
Just completely different situation. So another very interesting development is in the US equity market. So you may have seen the equity market, S&P 500 is up very strongly year to date, but actually underneath the surface, right, is all driven by the top 6 or 7 stocks, which is the mega cap tech companies. You can see Meta, Alphabet, Apple, Amazon, Microsoft, Nvidia. Aside, if you exclude them, look at the orange line there is flat. The S&P 500 is flat. So all of that is driven by those big companies. I think that brings a risk, which is the concentration risk, because it is very hard for an index to be just driven by those 6 stocks for prolonged period of time. So you either have to have the rest of the S&P catching up, or the top ones. People will be thinking, are they too expensive? Is it overbought? And so there is a risk that there could be a reversal in the current strong equity rally. So I think we are a bit cautious on that, actually. So very interesting development. So I think
Absolutely.
Yeah, our conclusion. So our conclusion is that things are better than expected, which is great. But in terms of the cycle, we actually are approaching the end of the cycle with a bit limited room to grow because of how tight the labor market is. There's an extent of how many jobs we can keep creating, and interest rates are still high. It could eventually put pressure on the economy, especially in the UK where people have to refinance. So I think we are still having a bit more cautious stance on the macro outlook at the moment, but after the inflation data, we do think that things are looking more positive. The thing is, overall speaking, we favor bonds at this stage because primarily the bond yields have risen so much previously. I mean, we haven't seen this kind of use for such a long period of time. So the risk reward, we think at this stage, is government bonds, especially UK yields. So that's an area that we favor at the moment. We favor less so equities, but we also believe that eventually the environment will be favorable because of lower inflation and the potential for interest rate cuts by the Federal Reserve eventually. So overall speaking, I think after the inflation data, things really look better. But I think in the UK specifically, we're still cautious. But generally, just think back, last year was horrendous for financial market. This year is much better. We hope there will be a repeat of anything like that last year, because primarily inflation there's evidence is under control, heading into the right direction. And that's really the most important thing.
Couldn't agree more. I think that's we've talked a lot over the last 12 months with various people about how sometimes bad news is good news. And, you know, seeing these things happen and maybe some negative some indices and things like that actually means that things are starting to turn in the right direction. And as you've said here, we're coming to the late stage of the economic cycle before we start to see a return to some hopefully good returns over the coming years. But Janet, thank you ever so much for your overview today. I think that's been fantastic just to get an idea of where we are. I think I'd just like to finish by saying, obviously, this really reiterates for me the reason why we diversify people's portfolios across lots of different economies. You know, just because we can see the UK is struggling right now, well, actually, the US is leading things out of their recession or very, very low level recession. And hopefully they'll be moving forward over the next 6 to 12 months. And then it won't be long before hopefully our inflation is under control here in the UK. And it does look like the Eurozone is probably not far behind the US as well. So from my perspective, I think it's been a really positive last few months. And whilst it's scary in terms of what's going on with interest rates, actually, there's some good news coming. So thank you very much for your time. Really appreciate you coming on. Thanks everyone for listening. And we'll be here again for our August update in the next few weeks. Thanks very much.